This is Energy Frontiers for the week. Hello everyone, I am Justina Okechukwu, and we say thank you to the African Energy Chamber for the support of the show. Now let's get started with some of the biggest energy news from here in Africa and around the world. The African Export-Import Bank has signed an agreement to grant a $300 million financing facility to oil and gas company Trident OGX of Congo. In a statement issued by Afreximbank, the transaction is expected to ramp up the Central African country's crude oil production by an estimated 30%. And French multinational Total Energies says it has completed a $400 million sale of 40% interest in its offshore Block 20 in the Kwanza Basin to Petronas Angola E&P Limited, a company belonging to the Petronas Group of companies. In another development, Total Energies says it plans to grow its power generation to more than 100 terawatt-hour by 2030, invest $4 billion per year and increase the company's cash flow from roughly $2 billion in 2023 to more than $4 billion by the year 2028. Egypt's Petroleum Ministry has launched a new bid round for international oil companies for gas and oil exploration in 23 new areas as the country seeks to boost its output of hydrocarbons amid a looming gas supply crunch. AIM-listed explorer Helium-1 announced in the week that drilling has commenced at the Tai-3 well in Tanzania's Rukwa project, with a plan to reach a target depth of 1,100 meters within the next 2 weeks. Russia's energy minister, Nikolai Shuginov, has warned that expectations of a quick lifting of the ban of fuel exports are futile, adding that the measure will be valid as long as necessary to stabilize fuel supply and prices. And that was a snapshot of your energy news headlines. When we return, global oil prices continue to rally higher in the final week of September. We go behind the figures with an analyst's perspective when the show returns. Welcome back to the program. Now, oil prices fell in early trade on Friday after spiking to their highest level in over a year on Thursday as declines in U.S. crude inventories added to worries over tight global supplies from OPEC Plus output cuts, and Russia's indefinite ban on diesel exports threatens to provoke a global shortage. The U.S. West Texas Intermediate futures touched $91.70 per barrel, while London Brent crude futures fell to $94.97 a barrel. So we turn to Julian Matonia, oil markets economist at Energy Intelligence, to know where oil prices and the markets are headed and what the consequences are for the global economy. Now, the oil price rally we've seen in the past week paused overnight. Where do you think they are headed as supply tightens?
Well, I think oil prices might surge above $100 per barrel. Yeah, it's not unthinkable at this point. I mean, you can see that prices have been swinging from supply resistance from OPEC at anything below $80 per barrel to demand rejection by buyers at anything above 100, maybe $110 per barrel. And you can see that the midpoint between the two is about 95, which is where we are now. So I think OPEC has been instrumental in turning the tide over the last few months, and as a result, our price outlook has been revised up by about $6-7. I mean, from $81 Brent on average in the first half of the year, we are now expecting $88 Brent in the second half of the year. So, those deep supply cuts, they will support prices. And we think Saudi Arabia will maintain its restraint to keep those prices buoyant. Now, if you look at macroeconomics, China, etc., it's still a little bit wobbly. So looking ahead, we could see $100 plus, but we don't think it's going to stay there very long, for all those macroeconomic headwinds.
Right. I think I heard the Saudi Arabia minister speaking about the fact that they'll keep reviewing those prices as the year comes to an end. Now, with Russia softening its ban on gasoline and diesel exports, as at yesterday, Russia said that the ban was indefinite and we shouldn't expect anything less. So, what is the implication of this on the global oil market?
Well, if a ban lasts forever, obviously the impact of the market could be significant. Now, I need to bring a little bit of nuance to that. Refiners in Russia lack storage. So that's a big thing because, at Energy Intelligence, we estimate that Russian diesel storage capacity is less than 30 million barrels per day altogether, which would likely fill in about 2 or 3 weeks during the current maintenance period. So, Russian refineries are under maintenance. So things are getting a bit slower. But even with that ongoing, it will fill up quite quickly. Maybe the country can add 10 million barrels of diesel in inventories, but that's not entirely sure. After that, refineries would have to run slower or shut down capacity, which would make things even worse than the current situation, in terms of fixing the domestic shortages on the Russian market, which is why with the story about indefinite cuts, we're not entirely sure about it. Long story short, we may have only 2 to 3 weeks before Russian diesel start to flood the market again. And if anything, this will help mitigate, any spikes in diesel prices. That's a very possible scenario.
So where does this leave other commodities like gas and coal in the near term?
So I think both gas and coal are intertwined. It's actually a very good point you make that, you mentioned those two, because if you remember last year, high gas prices after Russia invaded Ukraine and Russian gas led some countries to turn to relatively cheaper coal, and notably Germany, where coal made a comeback last year. And as a result, coal consumption in 2022 went up by something that more than 3%, I think. And it's likely to stay high this year and next year because, price spikes have sort of dented confidence that natural gas was an affordable alternative to oil and even to coal, by the way, especially in Asia. So for now, if you look at Europe, because Europe is a big pain point in the global market, gas stocks are very well filled. The weather is warmer than usual, especially again in Europe. But if that trend changes, say if the weather gets a lot colder, then there will be more demand for gas. And if prices reach the same, stratospheric heights as last year, then some power plant and some big industries will switch to coal. And this will support demand for coal, and by extension, coal prices. So everything is linked together.
Coming up, a busy week for the International Energy Agency as the Paris-based organization continues its campaign for a net zero energy future. More on this when we return.
Hello, I'm the Executive Chair of the Africa Energy Chamber. I want to ask you to join me and thousands of other energy professionals across Africa, the Middle East, Europe, and America at the Africa Energy Week in Cape Town, South Africa, from October 16th to the 20th. This event is going to feature top-notch leaders, speakers, government leaders, industry leaders, and Africa's energy players. You are going to listen to experts and decision makers on the most pressing issues affecting our industry today. Be part of an African energy renaissance, a movement that is committed to ending energy poverty in Africa and unleashing its full potential when it comes to energy growth and energy dominance. Let us join together and learn how to harness the power of innovation, technology, collaboration, to create a more sustainable and prosperous future for all Africans. You can help shape that future for Africa. Register now and get ready for an unforgettable experience. Our time is now.
This is Energy Frontiers. The International Energy Agency this week hosted government officials from over 40 countries, including more than 6 African states, at its first annual Critical Minerals and Clean Energy Summit in Paris. The idea was to advance global dialogue on how to safely and efficiently boost and diversify the supply of minerals, which are vital to clean energy technology. Listen now to the opening remarks of Fatih Biro, the Executive Director of the IEA at the closed-door summit.
So, why we today brought so many stakeholders around the world is to hear from them what needs to be done globally and what do you want IEA to do, more or less, and we will be very happy to hear your views. From our point of view, there are 3 blocks of the challenge we have in front of us. The first one is, how do we accelerate the supply diversification? This is the first issue that we are seeing a major challenge in front of us. The second one is, how do we unlock the power of technology and recycle? This is the second one. And the third one is how we make the supplies sustainable and responsible. So if I can say a few words on this 3 to provide a basis for our discussion. First of all, on in the new supplies and the diversification here, when we look at both the production and the refinery processing of the critical minerals, we see a very high level of concentration. High level of concentration. And this is, looking at the history of energy in the last 100 years, when there was a major concentration of one single country, one single company, one single route, there is always a challenge. Regardless of any other consideration, it can be an industrial accident, it can be a natural disaster, it can be anything. So in energy, what we learn is the IEA, the magic word is diversification. And here, today, when we look at the new investments coming around the world, while the investments are growing, but the concentration is growing as well. So this is something, a point that we think we all need to think about, how we can reverse this trend and how we can bring more diversification, both in terms of the production, but also in terms of processing and refining. The second point for us, we see as a block of this, a building block of this discussion, is on the demand side. How we can use the demand side policies in order to ease the strains on the supply side. How we can do it through recycling, through behavioral change, and there are some, of course, important government experiences, policy in some of the countries around this table. I hope they will share their experiences and their thoughts with us. So this is the second building block. The third one is on the, as we call it, as everybody calls it, on the ESG front. How we get the ESG considerations into policy and investment decisions. And we want investment decisions to be fair and equitable for also for the communities, and what kind of policies, regulations we have to put in place that the critical minerals are produced in a sustainable way and the local communities do benefit from that process. So this is the third area that we want to discuss, and we, in fact, organize our meeting today on these 3 building blocks: diversification, demand-side policies, and the ESG and the sustainability part.
And on Friday, the International Energy Agency, alongside the European Central Bank, the European Investment Bank, and other organizations such as the OECD, met in Paris for a high-level conference. The meeting looks to address the impacts of the ongoing global energy crisis on Europe's clean energy transition program and the role of central banks and advisory institutions in managing the risk related to the transition. Energy Frontiers grabbed a bit of that discourse for you.
And Europe here needs to find its position. How Europe is going to position itself in the new industrial age, the age of clean energy technology manufacturing. Last year in December, I shared with an op-ed in the Financial Times, which we call our mini manifesto in this context, why Europe needs a bold new industrial strategy and a master plan for the future that goes beyond the survival mode. The situation is so that the survival mode would not be enough to put Europe in a position being one of the key players in the next chapter of the industry. We know that there are some already elements in Europe. There are some work going on, Commission's new Green Deal industrial plan, and there are many nation-level initiatives as well. But despite its large internal market, skilled workforce, world-beating research and development, we are yet to see how Europe will put its ambitions into practice. We think the governments must take action, and very soon, for the region to remain a global industrial power, if we really want to stay like that.
According to firms, stricter climate standards provide a stronger incentive to invest than the physical impact of climate change. In other words, procrastinating will mean we run the risk of ending up in a halfway house where we are phasing out polluting energy sources before we can replace them with clean ones, a recipe for more price volatility and more political backlash. So the second element of a smooth transition, in our view, is understanding the challenge. And by this, I mean the specific obstacles that firms are facing in investing in the green transition. Our survey of Euro firms that I just mentioned shows that companies are actually ready to spend. 3/4 have already made plans or are making plans to make climate-related investment within the next 5 years. But the cost of the financing of these investments is an issue. More than half of the firms and 60% of small and medium-sized enterprises indicated that too high financing costs pose very significant obstacle. So this underscores the need to foster the market for green finance in Europe, which would reduce the risk premium and lower financing cost.
Ladies and gentlemen, I cannot hide the fact that I spent most of my life in government and parliament, in foreign affairs and security affairs and strategic discussions. And I must say the discussion that we often lead, also last week when we worked together in New York, was not always strategic. The way to strategic thinking is impossible without acknowledging the link between climate, technology, i.e. innovation, and development. And if we continue to think climate, innovation, and development in different boxes, then we have already lost now. We must bring these things together. We must answer questions from our partners in the Global South who say, what's in it for us? And they point at the maps who show you the development of the BRICS countries. Then they put another map to it and say, let's see where are the locations of the most critical raw materials that we in Europe badly need. And you will get a shock. And you better wake up and draw the consequences of this. And this then means that when we convince partners in the global south not to rely upon fossil fuels, but to join us on the way towards new technologies, then we must answer this question, which I heard from a very important African statesman who said, Bernard, what's in it for us? What you're doing with your wonderful wind farms on the high seas, which produce enormous amounts of electricity, which you then do not bring into our villages and towns in the mountains of my country. You use this electricity in order to fuel the electrolysis capacity you need for your green hydrogen, which you then put on boats or pipelines, bring it to the global north. The further value chain begins there. Isn't this colonialism 2.0? We need to take that seriously. If we want to get the global south on board, we better walk the talk when we talk about partnerships. So far, for me, it's often rather empty word.
We are down now to the final 3 weeks to the hosting of the African Energy Week 2023 edition in Cape Town, South Africa. Frontier Africa Reports Chief Executive Bosin Omofaye would be joining thousands of industry professionals and other international organizations from October 16 to 20 as they explore exciting investment prospects, tap into sustainable energy potential, and connect with influential global leaders and stakeholders at the African Energy Week. Energy Frontiers will be live every day from the African Energy Week Summit. Remember to follow our coverage of the AEW 2023 on Frontier Africa Reports website, subscribe to our YouTube, and follow us across all our social media handles as indicated on the screen. I am Justina Okechukwu, and that's your Energy Frontiers edition for the week. Thanks everyone for watching. I'll see you again.